Welcome to the deep dive. Today, we are wading into a sea of information gathered on November 18th, 2025. And this wasn't just a day of, standard market volatility. It felt like a flashpoint where the future of AI collided head on with some very real present day economic anxiety.
That's the perfect way to put it. That's the core tension we're unpacking. We have this huge stack of real-time reports, market data, political news, and it covers everything from these frenzied multi-billion-dollar AI deals all the way to, significant consumer pullback at major retailers.
So, our mission today is to try and connect those threads, specifically how delayed government data is feeding uncertainty in the market, even while this AI arms race just keeps accelerating.
Exactly.
Okay, so let's start with that reality check the global markets got. It was a broad retreat pretty much across the board.
A very broad retreat. In the U.S., stocks closed sharply lower. I mean, you had the Dow shedding nearly 500 points.
And the S&P 500, that was its longest slide since what, August?
Since August, yeah. And the tech-heavy NASDAQ fell over 1.2%. This wasn't just a blip.
It wasn't just here either. This was global.
It was absolutely global.
Yeah.
That retreat was amplified internationally. Asian markets got hit particularly hard. Japan's Nikkei was down over 3%.
Wow.
South Korea's Kospi, a similar margin. And in Europe, the Stoxx 600 closed at a one-month low.
So what was driving it? Because it doesn't feel like a traditional macro shock.
It wasn't. It was really a crisis of confidence and valuation.
Okay, and this is where it gets interesting. The central worry wasn't just the economy in general. It was this growing fear of an AI bubble. Why are investors suddenly hitting the brakes on the one technology that's supposed to be transforming everything?
I think they're worried about the physics of the investment itself. Tech stocks were getting pressured by these astronomical valuations, sure, but also a really key factor they're calling AI chip depreciation.
Okay, what does that mean? It's not like the chips are physically wearing out.
No, not at all. It's that the pace of innovation, the acceleration of Moore's law in the AI space, it's just so unbelievably rapid. The hardware you buy today for billions of dollars is dramatically less cost-effective tomorrow.
So if you're a company and you invest, say, $10 billion in a data center right now,
Right.
you might have to turn around and spend another $10 billion next year just to keep up with the efficiency of your competitors' brand new chips.
Precisely. It makes the return on that initial investment very, very questionable in the short to midterm. And you could see that pressure on NVIDIA.
The chip darling itself.
Exactly. It fell, 2 to 3% ahead of its earnings report. The market is just nervous that even NVIDIA can't meet the impossible growth expectations that are baked into these valuations.
And of course, we saw that classic risk-off behavior spill right over into crypto.
Immediately, it's become so correlated with speculative tech.
Bitcoin dipped below $90,000 for a bit, right? Its lowest since April.
It did. And the finding from strategists is, it's undeniable at this point. When investors get nervous, they shed high-risk tech holdings first, and Bitcoin is now firmly in that basket.
But that market fear, that nervousness, is such a strange contrast to where the actual money, the capital expenditure, is going.
It's a complete contradiction.
Yeah.
Which brings us to the actual high-stakes arms race funding this whole AI ecosystem.
And we're talking about Anthropic, the big rival to OpenAI, the company behind the Claude model.
Yes, they just secured a mega deal that pushes their valuation into the just staggering range of $350 billion.
And that's up from, what, $183 billion just in September?
Just in September. And it's being fueled by two giants, Microsoft and NVIDIA.
So what's fascinating here, though, is that this isn't a traditional investment, is it? Microsoft is putting it up to $5 billion, NVIDIA up to $10 billion?
Right, but that's not the real story. The real story is the commitment on the other side.
What do you mean?
Anthropic, in return, has to purchase $30 billion of Azure compute capacity from Microsoft.
$30 billion.
And commit to securing a massive amount of compute capacity using NVIDIA systems.
So this is less about cash and more about strategic vendor lock-in.
That's exactly. Anthropic is choosing its side in the infrastructure war. They are tying their entire future to Microsoft's cloud and NVIDIA's chips.
Which effectively locks out competitors like Google and Amazon from that huge future revenue stream.
Absolutely. The cost of entry to be a foundational player isn't measured in millions anymore. It's tens of billions for guaranteed long-term infrastructure.
And of course, the competition is reacting at light speed. Google immediately announced Gemini 3.
They did, promising it'll be significantly better at, and I'm quoting here, grasping depth and nuance.
Which means what for the user? Less prompting.
Basically, yeah.
Yeah.
They're trying to win on the cognitive side. reducing the effort it takes for you to get a good result.
And they're also pushing this new developer platform.
Yes, something called Google Anti-Gravity, which is built around this idea of vibe coding.
Vibe coding.
I know it sounds like buzz, but it means developers can just describe the task they want the code to do, the vibe of the function, and the AI generates the logic. They're trying to make their platform the absolute easiest to build on.
So while Google and Anthropic are in an arms race to build these agents, Microsoft is already focusing on managing them.
And managing the chaos they're going to create. They launched a tool called Agent 365.
For IT administrators. So this is basically corporate AI governance becoming a real product.
It's vital. Agent 365 lets IT control, track, approve, and spot security risks in all the AI agents running on their system, even ones from third parties like Adobe or ServiceNow.
Because without that, you'd just have thousands of these little unsupervised bots running around.
Potentially stealing data or just breaking things, Microsoft sees that coming.
Speaking of breaking things, even the cloud infrastructure itself proved to be shockingly fragile.
Yeah, that Cloudflare outage was a big one. It temporarily knocked major services offline.
I mean, we're talking X, ChatGPT, Shopify, even Anthropic's Claude.
Everything goes down with it. And what's so fascinating is the root cause.
It wasn't some huge malicious attack, right?
No, not state-sponsored cyber warfare. It was, and this is almost banal, an automatically generated configuration file that simply grew beyond an expected size.
Wait, hold on. For infrastructure that critical that basically half the internet relies on, how is it possible a config file size isn't managed dynamically?
That's the question.
Does this signal a kind of systemic fragility?
Right.
That the most advanced systems can be taken down by a glorified glitch?
It really raises a profound question about technical debt. You know, these massive interconnected systems, they still rely on legacy pieces or have these oversight blind spots.
And while the recovery was quick, it just underlines how a single point of failure can have these catastrophic global consequences now.
It does. And that structural fragility, coupled with some political paralysis, brings us to the next big theme, the economic headwinds hitting consumers and, traditional businesses.
And the whole context here is shaped by politics. The 43-day government shutdown delayed all the key economic indicators.
So we have a data blackout, which means the Fed is, for all intents and purposes, flying partially blind right now.
And that's creating this self-inflicted uncertainty.
Exactly. And you saw the bond market react to that. The 10-year Treasury yield dipped, the 2-year dropped.
Because nobody knows what's really happening.
Right. And any expectation of a December Fed rate cut has basically receded. The market just hates ambiguity.
And the little data we did get was soft.
Very soft.
Yeah.
ADP showed private employers cut about 2,500 jobs per week over the last 4 weeks.
And jobless claims came in higher than expected.
At 232,000. It all points to a chilling effect from higher rates finally hitting the labor market.
And that softness was mirrored really dramatically in retail. Home Depot missed its earnings and cut its outlook for the whole year.
Yeah, and their CFO was very direct. He pointed to consumer uncertainty, high interest rates, and a weak housing market.
So what was the interesting detail in their numbers? I saw something about a shift in mindset.
Yes. So their overall customer transactions fell. It means less foot traffic, smaller baskets. But their big-ticket transactions, anything over $1,000, actually went up slightly.
Huh. So the high-end consumer with cash is still doing the big renovation.
Exactly. But the typical homeowner is hitting pause. They're adopting what Home Depot called a deferral mindset for those small to mid-sized discretionary projects.
The very projects that keep the lights on for them day to day.
It's a very bifurcated economy. And speaking of disappointing consumers, we saw this incredible public admission of failure from Panera Bread.
Oh, this was amazing. They were the undisputed fast casual champ. Now they're number 3, and they're basically saying, are bad.
They are. They're reversing these major cost-cutting measures in their new Panera Rise turnaround plan. It's a textbook lesson in how you can destroy brand value.
Their public mea culpa was so specific. They admitted to shrinking portion sizes.
And switching to a mix of half romaine, half iceberg lettuce. A move that customers clearly noticed and, hated.
It just shows how these tiny penny-pinching cuts can destroy trust faster than one big mistake.
Absolutely. They tried to save pennies on lettuce and labor and lost their quality perception. So now they're going back to all romaine.
And they're bringing back sliced cherry tomatoes and avocados.
Crucially, yes.
Yeah.
They're bringing back the labor that shows care, and they're pivoting to what they call a barbell menu strategy.
What does that mean?
It means they need to win at both ends. They need some premium, high-profit items to drive up the average check.
Okay.
But they also need some ultra-high-value, low-cost options to win back the price-sensitive customer who left. They're trying to rebuild trust by being honest about value.
So moving from the consumer wallet to the power brokers, let's pivot to policy and legal shifts. It feels like policy is just desperately trying to catch up with everything else.
It really is. Starting with some very high-stakes politics in Texas, a federal court blocked the state from using its new congressional map.
On what grounds?
They found substantial evidence of racial gerrymandering. So the ruling aims to protect the 2026 midterms by using the previous map from 2021.
And Texas is appealing, I assume.
Immediately, yes.
Yeah.
They announced plans to appeal.
Then on Capitol Hill, the drama around the Jeffrey Epstein files seemed to reach a climax.
It did. The House voted overwhelmingly 427-1 to order the Department of Justice to release all of those related files. The political maneuvering was very visible.
Yeah, what was notable there was President Trump's sudden reversal.
A complete 180. He shifted to support the bill after resisting it. This all came after that very public moment where he lashed out at a reporter for asking about the files and called for their network's license to be revoked.
Shifting back to corporate power, Meta scored a huge victory.
A massive one. They won their long-running FTC antitrust trial over the acquisitions of Instagram and WhatsApp.
And this all came down to how the judge defined the market, right?
Exactly. The judge ruled the FTC failed to prove Meta has a current monopoly. The key finding cited competitive threats from platforms like TikTok and YouTube.
So the court recognized that the whole market has structurally shifted to video.
Right. And that the world in which they bought Instagram and WhatsApp is fundamentally different from the competitive landscape today. The market just moves faster than the legal system.
Speaking of things moving fast, let's tie the AI arms race back to energy. Because running these models takes a phenomenal amount of power.
An incredible amount. And
Yeah.
we saw the government step in to help feed that hunger. The Department of Energy announced a $1 billion loan to Constellation Energy
To do what?
to restart 3 Mile Island Unit 1. They're renaming it the Crane Clean Energy Center.
But this isn't just a nuclear power story.
Okay, what's the connection?
The restart is directly supported by a power purchase agreement with Microsoft.
Ah, so Microsoft is guaranteeing the revenue by committing to buy the power.
Specifically to meet its exploding data center demands in that region. This is maybe the clearest evidence we've seen that AI's energy consumption is now a critical national infrastructure issue.
It is. The scale of AI is literally changing the electric grid.
And finally, let's touch on consumer protection, because all this complexity creates new risks.
It does. In the UK, the government is moving to ban the resale of live event tickets above face value.
For concerts, sports, everything, this is a big deal for fans.
A huge deal. It's a policy response to years of outrage. And Live Nation, which owns Ticketmaster, surprisingly supports the ban.
Which is interesting. Maybe they see a way to control the inventory and capture more profit on the primary sale.
Could be. Meanwhile, shares of their competitor, StubHub, they fell.
And on the financial front, more fraud.
Always. The FTC is warning about a new high-pressure Social Security scam. Emails claiming your SSN might be suspended. Consumers lost over $12.5 billion to fraud in 2024.
And that disproportionately hits older adults.
Overwhelmingly. And this complexity extends to debt, too, especially with buy now, pay later services.
BNPL. We're hearing that up to half of all holiday shoppers are planning to use it.
That's the number. And credit counselors lay out a very specific acceptable scenario. It's got to be 0% interest, it has to fit your budget, and it should be for a one-off necessary purchase.
But the risks are real.
Very real. Things like late fees, Klarna, can be up to $7 per installment, can lead very quickly to debt collection and damage to your credit score. The ease of use really masks that debt risk.
So when we zoom out and try to synthesize all of this, we see these two massive competing forces, don't we?
We do. On one hand, you have the nervous, jittery investor. They're retreating from speculative assets like Bitcoin and tech stocks because they're afraid of the valuations. That's the contractionary force.
And on the other hand,
That is contrasted so sharply with the expansionary force. The enormous structural ongoing capital investment being committed to the core AI ecosystem.
we saw it with Anthropic, with Google's new models, Microsoft's Agent 365.
Even the nuclear power deals. The fear of a stock market bubble is fighting this structural belief that AI is the definitive next economy.
So the capital is flowing where the technology is structurally necessary, even if the markets are nervous about the stock prices of the companies building it.
That's it. Money is following long-term necessity, not short-term quarterly expectations.
And that tension brings us to a final provocative thought. We can see it playing out in another disruptive sector, electric vehicles.
Yes. Our sources note that EVs have definitively won the battle for superior speed and performance. They accelerate faster than gas cars, period.
End of story on that front. And yet, EV sales are still struggling. They haven't even cracked 10% of new car sales in the U.S.
Right, so the automakers are having to pivot. They're changing their focus from the flashy stuff, the 0 to 60 time, to the fundamental practical things.
Like price, charging infrastructure, and total range. The performance battle is over, and it turns out that didn't solve mass adoption.
Which raises this powerful question for you, the listener, trying to navigate all this. If sheer speed, raw performance, if that's no longer the metric for success in a disruptive field like EVs,
Then what is?
exactly.
Yeah.
What is the foundational, maybe even boring, non-flashy problem that has to be solved to get true widespread adoption in something like AI?
Is it just price? Making compute costs negligible?
Could be. Or, does our own consumer behavior, our own expectations need to shift so that the current state of the infrastructure just feels good enough?
It's a compelling thought. Sometimes the next leap forward isn't faster, it's just more reliable, more affordable, less complicated. That's our deep dive for today, connecting the chaos of the markets, the building blocks of our future economy. We'll see you next time.